Welcome to today's video, where we discuss the recent closures of Silicon Valley Bank and Signature Bank, and the potential risks facing the U.S. banking system. According to a recent study, up to 186 banks in the U.S. may have similar systemic risks to Silicon Valley Bank, which has sparked concerns and actions from regulators, customers, and investors. First, let's recap the latest news. On March 18, Bloomberg reported that First Citizens Bancshares Inc. is considering a takeover bid for Silicon Valley Bank, while at least one other potential buyer is also interested in the failed bank. However, the fate of SVB is still uncertain, and its closure has triggered a large amount of deposit outflows from regional banks to some of the largest banks in the U.S., such as J.P. Morgan Chase and Bank of America. To address this issue, the Mid-Sized Bank Coalition of America has asked U.S. federal regulators to expand FDIC insurance to cover all deposits within the next 2 years, which may help prevent further outflows and restore confidence in the banking system. Second, let's explore the role of Warren Buffett in this market turmoil. As you may know, Warren Buffett is one of the most successful investors in the world, and his Berkshire Hathaway conglomerate has a significant stake in the U.S. financial sector. In the past week, Buffett has had several discussions with the Biden administration about the current market conditions, and he may invest in the U.S. regional banking industry in some way, while also offering advice and guidance to banks in crisis. Interestingly, on Twitter, some users have noted that a large number of private planes arrived at the Berkshire Hathaway headquarters in Omaha on Friday afternoon, which may suggest that Buffett is taking action to support banks in need. In the past, Buffett has used his investment position and financial strength to help banks during critical moments, such as during the 2008 financial crisis when he invested $5 billion in Goldman Sachs preferred stock and indirectly saved the entire U.S. financial system. Therefore, his potential involvement in the current banking crisis may be a positive signal for the market and investors. Third, let's examine the actions taken by U.S. regulators to avoid a wider banking crisis. Since the SVB scandal, the U.S. Treasury, the Federal Reserve, and the FDIC have issued a joint statement announcing special measures to reassure customers and fully reimburse uninsured deposits in failed banks. In addition, the Federal Reserve has created a new bank term funding program to provide funding to banks, savings associations, and credit cooperatives, using U.S. Treasury, agency debt, and mortgage-backed securities and other eligible assets as collateral. According to Wally Adeyemo, Deputy Secretary of the U.S. Treasury, deposits in small and medium-sized banks across the country have started to stabilize and even rebound moderately following discussions between regulators and bank executives. However, not all experts are optimistic about the future of the U.S. banking system. Sheila Bair, former chairman of the Federal Deposit Insurance Corporation, warned in a recent U.S. media interview that the U.S. banking system is currently at a Bear Stearns moment, which refers to the 2008 investment bank that collapsed and triggered a global financial crisis. Without continued government assistance, Bair believes that the U.S. banking system could face a domino-like collapse, which would have severe consequences for the economy and society. Therefore, the U.S. Medium-Sized Bank Alliance has requested that the Federal Deposit Insurance Corporation expand its insurance to cover all deposits for the next 2 years, and proposed that the expanded insurance program should be paid for by the banks themselves, with increased deposit insurance assessments for lenders choosing to participate in the expanded coverage. According to the alliance, this measure would immediately stop the outflow of deposits from smaller banks, stabilize the banking industry, and significantly reduce the likelihood of further bank failures. In conclusion, the recent closure of Silicon Valley Bank and Signature Bank due to systemic risk has caused significant concern and anxiety in the U.S. financial market. According to a recent study, up to 186 banks in the U.S. may have similar risks, raising questions about the stability of the banking industry in the country. However, there are efforts being made by regulators and banking industry stakeholders to prevent a wider banking crisis. The Midsize Bank Coalition of America has requested that the FDIC expand its insurance to cover all deposits within the next 2 years, while the Federal Reserve has created a new bank term funding program to provide funding to banks and other financial institutions. Notably, Warren Buffett has had discussions with the Biden administration and may invest in the U.S. regional banking industry, potentially offering guidance and support to banks in crisis. While it remains to be seen how the situation will develop, it is clear that proactive measures are necessary to ensure the stability and health of the U.S. banking system. By working together, regulators, banks, and other stakeholders can help prevent a wider banking crisis and ensure the continued functioning of the U.S. financial market. That's all for today. Please subscribe and leave your comments below. Thanks for watching.